Scroll through any social media feed today, and you will eventually hit a wall of online trading gurus. They stand in front of supercars, flashing massive daily profit screenshots, promising young audiences that they too can achieve effortless wealth from their phones. But this setup presents an obvious, glaring paradox. If a trader is truly pulling down millions of dollars in the live stock market, why on earth would they bother spending their time charging teenagers $50 a month to learn their secrets? It is completely rational to view the trading education space as a total minefield. However, writing the entire industry off as a single uniform scam is actually factually inaccurate. To survive this ecosystem without blowing your life savings, a young trader has to completely ignore the flashy marketing. You have to look past the rented luxury cars and instead investigate the underlying microeconomics of the teachers themselves. Mapping out exactly how an educator gets paid reveals their hidden revenue incentives, exposing the structural difference between a financial predator and a genuine mentor. Let's start with the dark side. The reality of predatory actors is that they are marketers, not successful traders. For many of these self-proclaimed gurus, 90% or more of their actual income is derived directly from selling courses and chat room access, not from the market. But the extraction methods go deeper than a simple subscription fee. One common tactic is affiliate farming or broker kickbacks. This is where a guru forces new students to sign up using their specific links to high-fee, often unregulated trading platforms. The math here is incredibly hostile to the student. The guru earns a commission on every single trade the student executes. Whether that student wins or loses their entire account, the teacher gets paid simply because the student clicked a button. Then there is the most dangerous mechanic in the entire ecosystem, using students as exit liquidity. This happens primarily in low-volume, cheap assets like penny stocks or obscure cryptocurrencies. Look at this chart. To understand how exit liquidity works, we start with step 1. The teacher quietly buys up a massive block of shares in a completely dead, low-volume asset. Notice how flat the price remains while they accumulate their position in secret. Step 2. The trap is set. The teacher goes into their massive Discord channel and broadcasts an urgent alert, calling this exact asset the next hot stock play. Here is the immediate market reaction. Because the asset had such low trading volume to begin with, the sudden surge of localized buying power from thousands of naive students artificially rockets the stock's price upward. Finally, the climax. While the students are desperately buying in, the teacher dumps their cheap shares directly into that frenzy. The teacher walks away with massive profits, leaving the students holding the bag as the asset inevitably crashes. In these predatory communities, the teacher consumes the student's capital as the primary product of the business model. So if the dark side is that profitable, we have to return to our initial paradox. Why would a truly legitimate, highly profitable trader choose to spend their time running a community? For a professional, the primary reason to teach comes down to a risk mitigation strategy known as smoothing the equity curve. This graph illustrates the concept. Active trading is an inherently high-stress job. You have massive red weeks and huge green weeks, creating a volatile, jagged profit line. But when you overlay that with the predictable, risk-free cash flow of a monthly subscription model, it creates a steady, rising baseline. Having this stabilized income covers the mentor's day-to-day living expenses. It deliberately removes the psychological pressure of needing to win a trade just to pay rent, stripping desperation out of their live market decisions. Beyond income stabilization, there is a massive tactical benefit regarding scale. The global market is huge, and a single human brain simply cannot scan thousands of charts for specific formations simultaneously. By training a community to look for very specific technical criteria, the founder effectively builds a distributed radar system. Hundreds of well-trained eyes help surface high-probability market setups that the mentor would have completely missed on their own. Teaching also offers a profound psychological edge through the Feynman technique. Organizing a complex trading system into a strict, digestible curriculum forces the mentor to audit their own processes, adhere to their own rules, and remain deeply disciplined. Legitimate mentors do not teach to exploit naive capital. They do it because it logically stabilizes their volatile income and sharpens their personal edge in the market. Understanding the teacher's incentives is crucial. But we also have to look at the ultimate impact this spectrum has on the young, inexperienced trader navigating it. The downstream effects of landing in the predatory ecosystem are catastrophic. It trains students to view the stock market as a casino, breeding pure gambling tendencies, an addiction to high-leverage trades, and completely blown-out bank accounts. The brutal reality is that for the vast majority of young people, short-term active trading is an actively harmful pursuit. If they are buying the dream of trading from a beach with $100, they are going to lose their money. There are two structural reasons for this inevitable failure. First, young beginners simply lack the starting capital required to survive the harsh mathematical learning curve. Second, they usually lack the emotional maturity needed to endure the severe psychological stress of steep financial loss. There is, however, a positive exception. If a student manages to join an honest environment that focuses strictly on procedural discipline, the focus shifts from chasing momentum to building a systematic routine. Even if that student eventually decides that day trading isn't for them, a legitimate mentor provides deep, tangible value. They successfully impart crucial lessons in risk management, capital preservation, and how global macroeconomics work. Those are the underlying mechanics of building lifelong financial maturity.